Welcome to This Explainer. Today, we're going to cut right through all that confusing financial jargon and show you a surprisingly simple, practically zero maintenance strategy to confidently build wealth. And the best part? You don't have to sit there constantly monitoring the market. You might assume that successful investing means you need complex spreadsheets, hours of research, and expert stock picking skills. But the reality is actually staggering. Nearly 80% of active professional fund managers end up falling behind the major market indexes over time. Seriously, 80%. So if the pros can't even reliably beat the market, why in the world do we make it so hard on ourselves? Well, today we are going to completely demystify the whole investing process. We're breaking it down into 5 logical steps. First, the illusion of complexity. Second, the magic of diversification. Third, understanding ETFs. Fourth, building the 3-fund portfolio. And finally, rebalancing. This is going to take you from totally confused to completely confident. All right, let's dive right into section 1, the illusion of complexity, which is honestly a silent wealth killer. Look at this chart. It's wild how powerfully annual fees can erode your wealth. According to this SEC data, a seemingly tiny 1% fee from a financial advisor or an actively managed mutual fund can actually drain your portfolio by over $30,000 over 20 years, compared to low-fee options. Think about that. The industry standard is to just take 1% of your assets under management every single year. That's a massive chunk of your future wealth just poof, vanishing into thin air, which pretty much neutralizes any benefit you'd get from their complex strategies. So, to avoid those crazy fees, we're moving on to section 2, the magic of diversification and how it protects your wealth. The whole foundation of this strategy comes down to something called asset allocation. I know it sounds like jargon, but it's really just the process of dividing your investment portfolio among different asset categories. Things like high-growth stocks, stable bonds, and cash. How you mix these up is highly personal and depends entirely on your own timeline and how much risk you can stomach. The SEC actually uses this brilliant analogy. Imagine a street vendor selling both umbrellas and sunglasses. At first, selling 2 totally unrelated items seems kind of odd, right? But by selling umbrellas when it's pouring and sunglasses when it's sunny, that vendor diversifies their product line so they don't lose money on any given day. It's the exact same with investing. If one asset category drops, you're positioned to counteract those losses with better returns in another. Warren Buffett hit the nail on the head with this one. He said diversification is protection against ignorance. Basically, unless you're studying the stock market as your full-time day job, putting all your eggs in one basket is incredibly dangerous. Spreading your risk across the broader market is your ultimate protection. That way, if you own thousands of stocks and one company goes bust, your portfolio is perfectly fine. So what is the best, most cost-effective vehicle to pull this off? Let's move to section 3, ETFs explained. ETFs, or exchange-traded funds, are an absolute game changer. They basically pool money from a bunch of investors into a single basket that you can buy and sell throughout the day on the stock exchange, exactly like a regular stock. They offer high liquidity, super low minimum investments, and fantastic tax advantages. But the real magic? Passive index-based ETFs have microscopic expense ratios. We're talking fees sometimes as low as 0.05%. You can see right here from the SEC's official bulletin how these open-end investment companies are structured. They securely let you buy a tiny fractional slice of thousands of underlying companies all at once. And because of a clever arbitrage mechanism, they keep the market price of the ETF shares incredibly close to the actual value of those underlying stocks. With that foundation set, we've arrived at section 4, the 3-fund portfolio. This is the elegant solution we've been building towards. This strategy was popularized by the Bogleheads investing community, named after Vanguard founder John Bogle. And the vital takeaway here is that you literally only need 3 broad ETF classes to capture over 22,000 global securities. Just 3. By holding a total U.S. stock fund, a total international stock fund, and a broad bond fund, you completely remove the pressure of picking single winning stocks, and historically speaking, you're not going to underperform the broader market doing this. Now, how you mix these 3 funds is totally up to your risk tolerance. For younger investors with a long runway, your pie chart might look like this aggressive 80-20 portfolio. You'd heavily weight your investments towards the stock market since it has a higher upside, even if it's a bit more volatile. So you'd allocate 64% to US stocks, 16% to international stocks for some global balance, and just a 20% slice for bonds to give you a little stability. But hey, if you prefer a smoother ride, you can opt for a perfectly balanced equal 1/3 split. 1/3 US stocks, 1/3 international stocks, and 1/3 stable bonds.
This heavily tempers the volatility of the stock market with a robust foundation of fixed income bonds, which really helps protect you during economic downturns.
On the flip side, for conservative investors, say you're nearing retirement and care more about protecting what you have rather than aggressive growth, you'd look at a conservative 20/80 portfolio. Here, you allocate a massive 80% slice to much less volatile bonds, leaving only 20% in stocks. This heavily insulates your life savings from any sudden stock market crashes. And here is how actionable this really is. Take a look at this grid. No matter which major brokerage you use, you can build this exact portfolio today using these specific ultra-low-cost ticker symbols. Whether you go with Vanguard's VTI, VXUS, and BND, or Fidelity's zero-fee index funds, the framework is exactly the same. You are essentially buying the entire global market for pennies. Setting this up is easy, but keeping it on track requires one simple annual task. That brings us to our final step, Section 5. Rebalancing your investments. Here's the thing, as this SEC document points out, markets move. Over time, a booming sector like US stocks might grow way faster than your bonds. If you started with an equal split, a massive year in the stock market could suddenly mean US stocks make up nearly 50% of your pie. That pulls your portfolio completely out of alignment and secretly exposes you to much more risk than you originally signed up for. The fix is honestly super satisfying and highly mechanical. Just once a year, you follow these two steps. Sell off your winners and use those proceeds to buy your underperformers. If US stocks exploded, you sell a little off the top and use those profits to buy more of your lagging bonds or international stocks. It automatically forces you to buy low and sell high. It safely restores your original mix. And best of all, it completely removes human emotion from your investing strategy. We've seen how sneaky management fees quietly destroy your wealth, and how SEC-backed principles of diversification can be elegantly, flawlessly automated. By jumping on this incredibly powerful three-fund portfolio, you completely free yourself from market anxiety and staring at endless spreadsheets. So the only question left to ask yourself is, are you ready to beat the pros by simply buying the whole market?